You know, we see a very accommodative environment for private markets. It's a $13 trillion industry, but that's in light of an over $200 trillion investment universe. So we're still a small industry. We're 5 or 6% of total. So buying into these firms as they continue to take share from the old 60-40 portfolio is really an exciting place. And you just have to look over my shoulder at all the people that are here and excited to experience part of private markets. And I think the overall economic backdrop is accommodating for private markets for a long period of time. You know, the beauty of private markets is you're really not subject to the day-to-day ups and downs of the overall market. And we think fundamentally, most economies globally are doing quite well. Certainly the U.S. economy, and now an easing cycle, is going to have a little more tailwind to it. And overall, we think the best-in-class GPs are going to find their way to opportunities that are quite attractive for investors.
What I find very fascinating is that because there was a lack of transmission when rates were going up, that returns didn't get compromised. I don't know how that really played out for the private equity industry. But what does that mean in terms of DPIs, in terms of sustaining those high returns? I mean, we are at super return, right? So the key question is, where are the super returns in this accommodative policy?
You know, what's happened is our firms have had to hold on to positions longer as that process of price discovery works through the industry. It happens after sort of times of cyclical ups and downs. And we think we're at the point where buyers and sellers are coming together and going to find that price that's going to make transactions happen and drive that DPI. But the good news is, across our underlying managers' portfolio companies, underlying earnings growth has been double digits. So while they've had to hold on to their positions longer, they've grown through this cycle, and we think when exits come, they're going to be quite attractive.
And when are exits likely to come?
That's the $64,000 question. I think a lot of things are aligning now that the interest rate environment is easing in the U.S. I do think what we need to see are two things, just green shoots out of corporate M&A and the IPO market. And I think as you look at the forward calendar and what's being announced, I think when those start moving and you have a little bit of tailwind in U.S. rates, I think we're going to see a lot more deal activity in the coming quarters.